Hi, good evening, everybody. Welcome to another. Hi, good evening, everybody. Welcome to another session of Endowus live webinar. Today's session is about bubble trouble. The travel bubble between Singapore and Hong Kong again, I think looks like it's going to be cancelled. And markets, I think many people are talking about bubbles. Crypto has crashed and now is rebounding a little bit again. So there seems to be a lot of interest, and bubble seems to be a word that crops up a lot. I wrote an article over last weekend, a couple of weeks ago, on the Business Times called Bubble Trouble, and we thought it was a good idea, and we had a lot of good feedback about doing a session about bubbles. So welcome today to this session. I am Sam Ree. I am the Chairman and Chief Investment Officer of Endowus. Just a quick slide to let you know that we have a Slido question and poll session. So all our Q&A, if you can ask your questions on the Slido, and I will be checking that and coming back to you towards the end with any kind of I think I am back. I don't know what happened there. So let me share the slides again. Chingxi, if you're around, might be, oh, sorry. You can just, it's still on, right? Are we still broadcasting? Let me just share the screen because the screen disappeared on me. Apologies, everybody, if you're still with us. Sorry, this is. Okay, I'm sharing the screen again, presenting. Okay, there you go. So next week, I apologize for that technical difficulty. I don't know what happened. We got logged off and then I came back again. So next week is another session on cryptocurrency. So there's a lot of interest on cryptos. I think that it's a much more broad topic than it was several years ago. So a lot of exposure people have. And while Endowus does not have any crypto exposure or allow investments in crypto, it is a part of the investing, universe, and therefore we have KK who's joining us. He's a blogger and runs the blog Risk and Returns. He's actually quite well known as a crypto enthusiast and has asset allocation to crypto, and we'll have a wonderful conversation about cryptocurrencies in general, whether it's an investor's crypto night or a diversification must-have. And I'll spill the beans about my thoughts and my experiences with cryptocurrency. So please join us in this another exciting topic for discussion next week. Just a quick disclaimer and an introduction to Endowus, which is a company that is on a mission to help people invest better so they can live easier today and live better tomorrow and through retirement. Endowus is a fee-only wealth platform. It's a total wealth platform. It is not just a robo. It is a robo-advisor, but it's also a total wealth platform where you can manage all of your wealth. We're the first and only digital advisor approved by the CPF board, and therefore the only digital platform where you can manage all of your cash savings, your investments generally, but also your retirement money in the form of CPF and SRS. We won some amazing awards this year. Asia Asset Management, which is a very highly regarded magazine, voted us FinTech Innovation in Asset Management and Rising Star for Singapore. Asia FinTech Awards awarded us the Wealth Tech of the Year for 2021 in Singapore as well. And as you know, we've been backed by global venture capital companies like Lightspeed and SoftBank Ventures. We're here to solve the pain point of investing your own money, the high cost, poor, misaligned advice, and lack of access that exists here. The CEO and CIO of Morgan Stanley Investment Management Asia, and I've been building up Endowus for the past several years with this excellent team. So, how many bubbles has Sam seen? Is a question that I asked myself. I started my career in 1994 after university, and I've seen many bubbles. The Asian financial crisis was a bubble in credit, especially across Asia, and it was also a stock market bubble. This is the S&P 500, so it doesn't show it as well, but the markets rallied multiple folds before it collapsed and fell in US dollar terms as much as 90% plus across Thailand, Indonesia, and across Asia. The dot-com bubble burst also, in 2000, famously after a humongous rally in tech stocks and the NASDAQ. The global financial crisis was, another big bubble across, multiple areas and asset classes, especially housing in that period, but also the stock market. And, also I witnessed the Chinese A-share crash in 2007, but also again in 2015. So very sharp rise, followed by a very sharp fall. And then obviously we've, most recently experienced the correction in markets from the global COVID pandemic. And we're still at the highs, historical highs and all-time highs. And therefore the discussion about whether we're in a bubble again comes out. Now, where are the bubbles? So stocks are at an all-time high. You can see IPOs just going nuts. DoorDash, Airbnb, Coinbase, Coupang, so many IPOs that have gone up multiple folds after the market, debuted. And then meme stocks, GME is GameStop is, a stock that's very well represented, Reddit and these communities, and SPACs, which are backdoor listing vehicles that people raise money through. And while some of these have deflated or fallen, traditional asset classes across equities and fixed income and multiple asset classes have done well. But another key feature is physical assets. So real estate across the world, sneakers, art, wine, collectibles. This past week, apparently a trading card featuring the quarterback Tom Brady sold for a record $1.3 million. And obviously the virtual, the crypto, total value of Bitcoin hit $1 trillion. NFTs, artwork on a digital format, non-fungible tokens are selling for things, tens of millions often. And the highest obviously was recently from Beeple at 69 million. So bubbles are everywhere, it seems. But, one of the key definitions of bubbles are, defined by valuations. Especially traditional markets like equities, people look to valuations to be a sanity check to see whether markets are in bubble territory. If they are, then is it going to come back, and how much can it pull back? Now, this chart has been, I think, warped because in 2020, our valuations were hovering around the 20 times PE valuation, 20 times earnings. But suddenly it jumped to 30, and it wasn't because the price moved up. So if you see 2008, valuations also spiked, 2000 again. Oftentimes this was driven by the movement in the P in PE, which is price, and not earnings keeping up to that growth in price. But this time it was actually earnings which collapsed in 2020, and that led to the multiples, going up quite significantly. Despite P not moving as quickly as this. So we adjusted by using a cyclically adjusted PE, a 10-year rolling PE versus the earnings of a rolling 10-year period. And you can see that, what really stands out is the 1929 spike, which is just before the Great Depression, the Roaring Twenties, as it was called. And then the 2000 number, which is 99-2000, when the tech bubble last went to a 45 times CAPE price to earnings ratio. And so right now, where do we stand? It's about 36.6. So it's very high. Obviously, the earnings has collapsed recently, and therefore it's like inflated a little bit. But prices are always also at all-time highs, and therefore valuations seem to be high. But it also says, like in 2000, if it goes to 45 times, then obviously with earnings growth this year being especially high, we can actually see markets continue to go up before it comes down again. So whether we're in a bubble or not, I think, whichever way we cut it, the sentiment has definitely been bullish. So people, have said that, the markets are very bullish, people are very bullish. But if you look at the actual numbers, and this is a Bank of America Merrill Lynch study from the Global Investment Strategy team, the bull and bear indicators at about 6.9, which is high, but not as high as in the beginning of January 2020 when it was 7.2, which is the high recently. And it fell very quickly to zero in March 2020, which was an extreme bearish and buy opportunity. And the latest number is 6.9, so it's come back quite a lot. And I think whichever way you cut it, the sentiment is quite positive. But it's not at extreme levels that we think we are in. This is the fear and greed index from CNN, which shows extreme fear and extreme greed. And obviously, we went from extreme fear in March of 2020, just like at the end of 2018, which was the only negative full year in returns we saw over the past 3 years, since 2009, in fact. And then actually it rose quite sharply. And at the end of 2020 was when we had extreme greed and a very high level of optimism. And since then, it's actually been hovering around the 60-70% level, which is surprising. If we look at the history of bubbles, asset bubbles over the past 40 years, we've had many. The gold bubble in the 70s, the Japanese bubble, which many people talk about, and then the rest, which I've experienced, which is the Asian financial crisis, the bubble before that, the tech bubble, the US housing bubble, the China bubble, and even recently the biotech and the technology bubble. But nothing compares to the Bitcoin bubble that's shown here. But even that, as we know, has deflated very quickly. This is just since the all-time high, the peak to trough fall that, the various cryptocurrencies and altcoins, experienced. And I'll go into more detail next week when KK joins us for the webinar next week on cryptos. But needless to say, that crypto fear and greed index is at a much lower level. So, I think when we talk about bubbles, people, are like talking about it in a very conceptual way. But in the end, the financial markets, or any market, including Bitcoin or including art or any kind of asset, is always driven. The price of these assets are driven by demand and supply. I think people forget that. So let's revisit where we are in the cycle in terms of demand for example, equities here. Financial assets, the most common one being stock markets, and this is where most people focus on. So we'll focus on that today, is what is demand doing and what is supply doing? And what do I mean by demand? It's people buying stocks and funds and equities and ETFs that buy funds again, buy stocks. And then the supply. So what is the supply in the stock market is IPOs, when new shares are issued, or secondary transactions occur, where people who used to own, like an owner of a company suddenly dumps the stock in the market that he was holding onto, or in the case of Bitcoin, there's new supply that is unlocked and therefore comes to market. There is new supply that's coming on in the market. And so we have to look at this demand and supply dynamic. And I'll go through a few charts that will accentuate this very well. This is equity fund flows. And it's surprising that actually since 2018, and for long periods in 2015-16, it was negative. So we saw, weekly flows actually turning negative for a long period. And it's only in the very recent period of end of 2020 into 2021, especially in February, that we saw monthly fund flows actually increase quite significantly. And it's important to note the difference between equities and bonds. So the tiny numbers you can see at the bottom says that since 1997, cumulative bond fund flows have been $2 trillion versus equities of 671. So bonds have seen a much bigger inflow of money into their markets, and bond market is significantly bigger, multiple times bigger than the stock market, you must remember. But more importantly, since 2009, equities has actually seen virtually no increase and slight outflow in fund flows versus bonds, which have seen over $1.5 trillion of money flowing in. One of the key features, though, is that there has been a shift from active to passive management. So index funds and ETFs have seen tremendous flows in the trillions of dollars, which also helps stabilize the market. And this chart looks very similar to equity market movements. And where are the additional buyers coming from? Households in the US especially now own a tremendous amount of stocks. It's the highest it's been. Some of it is because the prices have gone up, and some of it is because they have bought equities. But the percentage of financial assets that households and personal trust hold is at an all-time high now. Companies actually have been buying back their own shares. It's been a key driver of robust markets and valuations. But obviously with the COVID crisis and cash flows being hit, it has come off a little bit. And so demand for households remain relatively strong, especially since people are using their stimulus checks to buy stocks on Robinhood and stuff. But if you look at the companies who have been buying back a lot of shares and driving their share price up and reducing supply of shares in the process of their own company, that has led to rising share prices and valuations as well. But that has come off quite a bit, although it's rebounded a little bit in the second half. And international investors have been continuing to buy US stocks at a record pace, in fact. Much more volatile. Previously, it was much more trending. It is volatile, but having said that, the overall number is a very high number and it's been rising. So the cumulative amount is quite high. And it also shows why the US remains such a dominant economy with its massive companies who are the brightest and the best. As I mentioned, a lot of things that we use, whether it's Amazon or Netflix or Google or Microsoft, is actually Apple. It's all US companies who have global presence, are very much our everyday, even here in Singapore. And it compares very starkly with the super terrible STI index, which obviously has much less growth companies. It has also much less global companies, and therefore, I think that international investors have continued to expose themselves to the great companies that are listed in the U.S., and that has implications for the U.S. dollar and also currencies and the stock market, obviously. What about supply then? So just keep looking at supply. The IPO market in the US for 50 million plus market cap has been really strong, especially last year coming into this year. And this year is just up to May, and we're already looking to cross the numbers for full year of every single year other than 2014 and 2020. So I wouldn't be surprised if this year is another bumper year. And there's a fallout to IPOs when there's new supply. After 2014, the equity markets, slowed down a little bit. And when there's supply, it has to be absorbed by the market. And if suddenly, supply rises and demand weakens at the same time, what happens to price? Obviously, I think price is what is adjusting. And this is very salient, especially in the recent weeks where we've seen, buy-sell volumes come off a little bit. And this is an analysis of the Global Fund Managers Survey to see where people are overweight or underweight in their positioning versus history. And you can see that actually bottom red highlighted bonds, they're underweight, and cash and USD obviously, but technology has finally actually moved to negative territory. So people are underweight technology for the first time, as opposed to all the cyclical and commodities, financials, etc. And it's interesting that, in a survey of these investors, what do you think is currently the most crowded trade, which is the longest, where are people long or short? And that's where most people believe, is very crowded. And the reason we say it's a crowded trade means that when everybody has already piled into it, it's probably the top of the asset class, and therefore it will come down. And it's interesting that actually even, in May survey, Bitcoin was considered the most crowded trade, and it was a bigger view than even in April. And that, is coincidentally what was timed with the crash in Bitcoin prices as well. But technology is less than April because of the positioning, but also, because the technology sector has come down. But I think that, some of the other ESG and US treasuries is very interesting to see. And tech has seen outflows. So it's been seeing the biggest outflows since December 2018, when they had a correction and the markets was negative. So it's the first time that we've seen this meaningful outflow, throughout last year into this year. And it follows a very sharp increase in inflows towards at the beginning of this year. And you can see that by looking at, the flagship ARK ETF, which is the technology innovation darling of the past couple of years, and had a tremendous run last year, but it's now in negative territory and has been falling. And it's actually in line with, an index which Goldman Sachs created of all technology companies, great or not so great, but basically if they're not profitable, because a lot of great tech companies are still unprofitable. Even the many companies like Coupang and others that I've mentioned are negative and have never generated a profit. And just like Amazon didn't for a very long time, because they were expensing costs immediately. And they were building infrastructure to build out the AWS business. And finally, they turned profitable. So just being unprofitable is not a reason to be negative a company. But it's interesting that ARK has a very heavy tilt towards these non-profitable tech index. And they have significant exposure to this space. And as a result, it's actually moved very closely together. Even crypto, Bitcoin, there's been studies that show that, in the short term, despite long term being a low correlating asset class, that the recent trends have shown that actually the Bitcoin price movement has been very closely correlated with NASDAQ futures. And this is understandable because I think as Bitcoin and crypto has moved into more mainstream, I think obviously fund flows, once again, demand supply, drives a lot of the price movements. And so, where technology goes, crypto goes, and that is becoming an increasing view that is dominating the markets. Just a step back here from just the bubble talk is, people do worry because, bubbles will burst and markets will fall, and we don't know when that will happen. We cannot time it. But also we have to understand that drawdowns and markets falling is not unusual. In any given year, and this is a data that's for S&P 500 going all the way back to the Great Depression in 1928. So this is almost 100 years of data. And in any given year, how many times does the market fall 5% or more? It's almost every year, 94%. 10% or worse is 63%, 20% or worse is 26%, and 30% or worse is 10%. So, the final 40% plus is, stuff like the tech bubble bursting and the global financial crisis. 30% or worse is examples like COVID last year, and 20% of worse or worse is recent example is 2018. When we saw the Fed raising interest rates and the market correcting about 20% during that time. So these things are actually more common, and we've actually seen a 20% correction and a 30% correction in just the last 3 years. So, it's actually happened quite a lot. But on the flip side, markets also every single year achieve all-time highs, which is amazing. In every single year over the past 8 years, we've seen double-digit all-time highs being achieved every single year. And again, last year we had 32 days, which is phenomenal because average trading day, as you know, is about 200 and something days. It's taking out the weekends and public holidays. And so, 2017, 62 days is phenomenal. And last year's 32 is quite high. And one thing that is counterintuitive is that people think that if I invest in any given day, that would normally be better than if I invest at the all-time highs of markets. But what happens if you look at the empirical evidence is that if you invest at all-time highs and look at what markets did 1 year, 3 year, and 5 years later, it actually does better than the days that you invest in any random given day. So you have a high probability of success. And the reason, and there's one more data point, which is the decades performance, entire market, how many days it was up, how many days it was down, and how many days it was not doing anything. And you can see that most days are up. And the reason is because equities has an upward sloping positive skew. This is why trying to time the market is generally not a good idea, because long-term markets do tend to rise. And the reason is because it is a market that has been already filtered for all the bad companies, all the small companies that cannot make it on the stock market, who haven't proven themselves in generating growth or profitability. So while there are tech companies that are unprofitable, the bulk of the market is still made up of profitable large companies. And therefore, they actually do tend to be adjusted. And the biggest companies always rise to the top, and they tend to do well. And that's what drives this long-term market performance. And it's a naturally self-fulfilling mechanism. You're adjusting every day. Tens of millions of people are buying and selling to discover the right price. So the market itself is doing its work and trying to find the right price and drive the market towards the money towards the best stocks, and then sell the companies down when the companies are not doing well. So this natural mechanism, and Warren Buffett famously said, it's a voting machine in the short term, but a weighing machine in the long term. So voting machine means that the tens of million people who are buying and selling every day will find a price, and the people who believe that this has higher value, like GameStop, through Reddit crowds pushing it up, or short, covering shorts, or Bitcoin, a crypto that has no intrinsic value or any use really. People believe that because of its limited supply and because it's a holder of value and it's an asset, you just accord it a certain price. So that demand supply dynamic and discovering a price is the voting machine in the short term. But in the long term, he says it's a weighing machine. Things that are intangible, that are not really adding value, which is not creating earnings and cash flow and tangible stuff like that, which may seem like an outdated concept these days, but may come back in vogue again. We do need to be pragmatic and understand that things come in cycles and waves. And therefore, we should understand that there is a risk out there that, the weighing machine will come back. And that's, what markets do. They tend to go up for much longer and much more than we imagine. And the short periods that it falls is actually much, much shorter than we think. And the fall last year of 33.8% was over before we could even blink, in 1.5 months, and 1.1 month actually. And since then, the market has continued to roar higher. So where are the remaining opportunities then, if there is a bubble in everything and they're all going to deflate? So it's interesting that we have seen some, flows I'll come back to bonds later, but for the right chart shows, as technology has seen outflows, the sectors that have actually taken over leadership in the equity markets is energy, materials, or financials. And so you can see that actually flows into this sector has been quite high, and it's been driving that higher. And this asset class quilt shows that it's very difficult to predict what will be the winner next. But it's really interesting that commodities year to date has seen a massive rebound. And it's the first time commodities have come back on top for the first time since 2002. So almost 2 decades since we last saw it, commodities is back on top. And you can see that, these volatile changes will continue in the market. But one thing that is, really a talk of town in the equity markets is that, value is really coming back. And this is the French and Farmer high versus low price to book. So low is value and high is growth. And as you can see, after many years of underperforming, finally 2000, we saw a breakout of value, especially in the last several months of the year. And then again, this year to date, it has continued to outperform. And if you look at all the gray lines of the almost 100 years of performance, you can see that, yes, obviously there are periods, especially in the past decade, when growth has outperformed value, but value has started to outperform. And if you do the average of everything, then obviously we know that value has done better than growth over long periods of time. So it's really interesting to note this. And if you're looking for opportunities, I don't think that the short value trade is now working anymore. And so we should be very well aware of that. And as you know, Endowus works very closely with Dimensional, which has Kenneth French and Farmer, the original academics who did this research about the long-term factors of return and how value has outperformed over long periods, as has small companies and also quality, and at some time and during some periods momentum. So Dimensional is a fund manager that we work very closely with. We are exclusive distributors of their funds, and they tilt their funds towards these proven factors of return, such as value, quality, and small. And they've seen great performance since last year. But some things change. Demand changes, supply changes, but some things remain the same. And in the end, people will say it's all about the Fed, because it's actually Fed's fund rate, the cost of money, interest rates, which have been artificially kept low. It's the Fed's prime pumping, Fed easing and printing money that has led to very loose monetary conditions. And in the end, this is what really drives markets and the liquidity and what creates bubbles. So we need to closely track what the Fed fund rates will do. But obviously, checks and stimuluses keep coming and has kept confidence high. And despite all the talk about the K-shaped recovery, and the K-shaped recovery, for those that you don't know, normally people talk about a V-shaped recovery, which was COVID last year in the market. It just fell very sharply and bounced back. That's V-shaped. Some people talk about a U-shaped recovery. It takes a long time to recover. It slowly recovers over a long period of time. What Kay is saying that is actually we've seen a massive income inequality. There's been a massive wealth divide also, as asset owners have continued to enjoy great returns, whereas income-focused people and who don't have assets, who have not invested in stocks, who have not bought a house, have suffered. And therefore this K-shape, so the asset owners have outperformed, whereas income and those that are not in financial assets have actually underperformed. One of the major reasons why they underperform is not only because they have lack of income and lack of savings, or they're young and they don't have enough money saved up. All of these are very depressing situations. But the other reason is even people with money have been very overweight cash and have held on to too much cash, which is negative yielding at the moment, and therefore they suffer from that. But despite that, wage growth in the US especially has rebounded, and salaries, even in our company and tech sector in general, continues to rise. So there seems to be a dearth of great quality of people to be found, and therefore their wages seem to be going up. And that obviously leads to inflationary concerns. And that's been the real topic du jour of all macro, especially, and market commentaries, recently, where inflation expectations, especially in this rebound, rises to the fore. And it's driven by the strong economic rebound post-COVID, with vaccinations increasing and leading to earnings recovery. And returning growth, rising wages obviously lead to inflationary expectations, which lead to rate hikes. And so far in developed markets, it's really been more on the long end, and emerging markets have seen interest rates rise slightly as well. But what it leads to is a steepening of the yield curve. And this is the reason why financials and banks do well. When the yield curve steepens, they borrow in the short end and lend in the long rate, and they're able to keep that spread. And that's why banks love a steep yield curve, and they benefit from that. But also as investors, we should also be aware that apart from equities, bonds has been a major concern in markets. But if you remain a long-term investor in bonds as well, these rising interest rates, especially in the long end, is actually a positive, because any money and bonds that mature, you're able to reinvest at a higher interest rate, and therefore maybe we can maintain a return for fixed income that will be higher than expected. And fixed income has come in for a lot of bashing because we were at the peak of the long-term cycle, and fixed income has done well, and interest rates are so low. And as interest rates rise, we're likely to see capital appreciation turning negative, because interest rates rising leads to bond prices falling. But having said that, in every bubble, especially since we're talking about bubbles today, in every crisis, even in COVID-19, you can see that fixed income is still doing its job. And especially if you're worried about markets and bubbles, then you should definitely have some allocation to fixed income. And there are still opportunities that exist in fixed income to generate higher yield through high yield bonds and emerging markets, but also even in some quality investment grade bonds, especially if you go out in duration. As I showed you with the steepening yield curve, you're finding opportunities. And so diversification still works. Both stocks and bonds have a negative correlation. This may change if we see very high inflation. But inflation doesn't seem like it's going to be like shooting up to historical highs, or the numbers that we used to see in the 70s. And so if it's manageable, then we think that stocks and bonds will still maintain their negative correlation. And returns between asset classes and between cycles normally evens out over the long term. And this is why it's so important to try not to time the market. You are not smarter than the market. The cost of trying to time the market is very, very high. The growth of $1,000 invested in US stocks, and this is again a very long dated chart, 50 years. So I was born in 1972, so 2 years before I was born. From 1970 to March 2020, if you had invested $1,000 in the US stock market, then it would have returned 121x. So massive returns. But if you had missed the best performing day, it falls to 108. If you missed 5 days, just 1 week, one trading week, that would have fallen to 77, almost halving. And then if you miss 25 days, which is just over a month, that falls to 26x. So it goes down by a factor of 5, 1/5. So it's amazing statistics. But basically what happens is that markets fall, and the best performing days, the single best performing days, are normally at the bottom of the market, where it rebounds very sharply. It might fall again and then rebound sharply, but what happens is that the markets go up the most when the markets are at the lowest point. And it's impossible to time that. And we say in finance that picking bottoms is a dirty business. And the reason is because it really is very difficult to do. And unless you're invested at the bottom, you cannot time that rebound. And so it's really important for you to remain invested in markets so that you can benefit from the long-term power of markets to give you compounded returns, rather than try to pick the top and pick the bottom, because these are all very difficult to do, and human beings have proven that they're not very good at doing it. So I'll stop there, and just a quick one on Endowus, how you can save better, invest better, and build better on the Endowus.com wealth platform. If you haven't checked it out, then please go to endowus.com and see for yourself. It really is completely free. Our new low entry point, so our minimum has been reduced to $1,000. So more people can access the Endowus wealth platform. So please let your friends and family people know. We do understand that the 10,000 minimum has held people up, especially if you're a young investor and you want to invest in Endowus but haven't been able to do so. Please do so. Also, our mobile app on iOS and Google is also out on Android. So please let your friends know or download the app and use it. So with that, another plug for next week's session, and I'll go to the Q&As. So thanks, guys. There's a lot of questions. Hi, does Endowus have any plans to add crypto into? Okay, great question. So I'll share more next week. We have looked into it, guys, and we do understand that it's a popular use. We have talked about how Morgan Stanley has done it in the US and allowing access to only the very, very high risk profile investors, investing up to 2.5% asset allocation in their total portfolio. So that kind of approach I think is reasonable. Also, it has to be the right vehicle. It has to be an efficient vehicle. I think maybe ETFs, which haven't been allowed in the US but have been allowed in Canada, may be a good vehicle. We've seen only one ETP in the exchange traded product, not a fund, that has multiple cryptocurrencies. That gives you some level of diversification, because having all your bets in one crypto versus having a broad-based exposure may be it's debatable. We'll talk about that next week, but I don't want to steal the thunder. But whether it's a great diversifier is another question, because cryptocurrency and technology has been very highly correlated recently, and so it's not been a great diversifier recently. It's moved exactly in line with ARK, Innovation Fund, for example. So it's difficult to tell that, when it was not a widely held asset and it was a niche asset class, then obviously the correlation is going to be much lower. But as it comes into the mainstream, I do think that there is a risk that cryptocurrency becomes much more highly correlated to other asset classes. If I invest at a high now in the bubble burst, what will happen to my funds in Endowus? How long will I think our moderator has answered that question, but it really depends on the market. If you look at the two recent examples, 2018, where markets fell 20% and recovered a little bit slower, versus March 2020, when it fell very sharply but rebounded very sharply. And remember, last year, everybody worried about COVID and the sharp market falls and got spooked when markets fell 33%. But last year was a plus year. It ended up being a double-digit up year for most asset classes. And so it's really important to understand that if the bubble bursts and markets do fall, we do need to understand that markets will recover. It will go higher. It will reach all-time highs in the future, just like it did after the tech bubble burst. The tech bubble arguably was a much, much bigger bubble. I showed in my slides that actually, this time around, the valuations are not as high as in 1999, 2000 before the tech bubble burst. The earnings are artificially deflated right now and are actually just recovering. You have to also understand that, 1999, 2000 was multi-years of, markets continue to go up in a straight line. Whereas recently you saw 2018, markets fall 20%. 2020, markets fell 33% from the peak. So we've had these healthy corrections along the way. And despite that, markets have continued to rise. So I think it's important to understand the big picture, look at the long term and see where markets are, and look at your investments from that perspective. What is your view on inflation? Are we entering a long cycle of high inflation rates? Is it still worth holding fixed income assets? I think I answered the fixed income question in the presentation, so please take a look at it. But inflation is a tricky one, because I think it's still too early. While the common belief and the base case scenario is that it will be transitory, it will be cyclical, and maybe we'll see a slightly higher inflation, trend inflation than in recent past. But we have to understand that the recent past is abnormal. 2008-9 saw a massive deflationary shock with households, balance sheets being significantly damaged, and therefore inflation was artificially low. And you had also a proliferation of technology, which also led to disinflationary pressures. Think about what Netflix did versus how much you spent on DVDs. Think about what Amazon has done to retail pricing, Zara, all these like disinflationary solutions and digital platforms that are lowering costs, just like Endowus, is disinflationary. So I think there's been a period where there's been artificial disinflationary pressures. Some of these are dissipating. You're seeing massive supply side shocks. So people are not being able to manufacture material, produce goods, mine, maybe even build houses. So the supply side has been massively disrupted in the past 12, 18 months. And that has led to this imbalance, again, demand and supply, and what happens to price. Inflation is price. So what happens to demand and supply? Supply side shocks lead to reduced supply, while demand also had a shock but rebounded. So there was a deflationary shock, and then you have a rebound, and supply has been curtailed and demand has gone faster than supply has been able to keep up. And that's why we're seeing these inflationary pressures, especially in commodities, especially in certain assets, and housing, for example, where even now in Singapore, semi-lockdown and construction is grinding to a halt again. So supply is the problem here, and if supply issue is solved, either because we have a lot more vaccines and people go back to work, or because people normalize and more like automation happens and therefore you have more supply. If the supply side issues are solved, then I think pricing will readjust depending on where demand is. Is Endowus going to add any alternative offerings? What do you think is the best alternative investment in terms of low correlation? So Endowus is busy building out its core solutions. As you can see, the cash solutions, the core investment solutions. We launched the industry's first ESG solutions, also FundSmart. The FundSmart platform is where we will start adding the alternative investment solutions. So we'll be adding, maybe liquid alternatives, but we'll be also offering to our accredited investors, because a lot of these alternative investments are only available to accredited investors. So we may be able to offer private equity, private debt, and also hedge funds or fund of funds and venture capital in the future. So please look out for that. Please email support@endowus.com and reach out to one of our MAS licensed financial advisors, and they'll be able to help you, and we'll be able to share with you more, especially if you're an accredited investor, on the alternative investments that will be offered on the Endowus platform, especially on the FundSmart platform. What are the best alternative investments with low correlation? Low correlation to what would be my question? If it's just equities and stock markets, there's many asset classes, even like public, like fixed income has low correlation or negative correlation. Gold can have low correlation. Commodities sometimes has low correlation, although it's difficult to say because markets tend to move together. But there are, private equity, private debt, fund of funds. There are many wonderful tools that can be used to hedge or provide, lower correlation in times of especially crisis. Okay, so I've answered quite a few questions. What does Endowus have in place that is better than other competitors such as Stashaway and Syfe? Ooh, where do I start? So apart from the fact that we do have a total wealth platform, so I think that if you look at what Stashaway offers, it's actually at its core, it's a very simple single platform product. It doesn't have the kind of broad choices that Endowus has. So Stashaway and Syfe are both fund managers. So they're licensed as a discretionary fund management company. and they build products. So what the products are is like a fund. So Stashaway has a macro active asset allocation fund. They like buy China internet, sell gold, sell US equities, buy gold, sell European equities, and they do it without your consent. They can do whatever they want. And so they make these changes based on what they say is an algorithm. But it's really not an algorithm. It really is, I think, mostly like, decisions made by the investment team based on inputs from the data that comes out from the algorithm. And these decisions are very active in its asset allocation. And syfe also builds products in the sense that they have a growth fund, they have a REITs fund, they have core fund, and all these different funds. So both of them are developing product. We work with the best product providers in the world. So the biggest fixed income manager, PIMCO, biggest passive manager, Vanguard and BlackRock, and the best and the brightest active, fund managers, alternative fund managers around the world. We're, almost 30 fund managers work strategically with us to offer their best solutions. And so, if Stashaway and syfe has their growth fund is great and they perform well, then we will screen all the growth funds that are out there, and we'll put syfe's fund onto our platform. We don't have any problems with that. We can offer Stashaway's fund, their macro asset allocation fund, if it's great. But unfortunately, when we screen it, it doesn't hold up very well versus all the other funds that are out there. So, our FundSmart platform and our core advice portfolios actually, are made up of the best-in-class funds. I mentioned Dimensional, for example, which has had great performance recently because of the value tilt that they have and the small company tilt. So, we have these smart beta products, which are really proven track record, who manage hundreds of billions of dollars, who have global presence, who have massive research teams and portfolio investment teams and trading execution teams. And they do this at really low cost. So we can provide you with institutional quality, the type of investments that GIC and Temasek would make, rather than some random robo who've never really managed money before creating some portfolio for you. So I think it's very different. We don't try to create our own portfolios. We work with the best in breed. So the way to look at us is almost like a digital private bank. So like a UBS or the Credit Suisse private bank would have all these solutions, and you would need like $10 million to get an account there. But at Endowus, we have all these solutions and institutional solutions that are available, that we have made available to everybody, including your CPF and SRS, from as low as $1,000. So I think it's a fundamentally different business model with a very different philosophy and process in investing. Okay, we have some questions about value. How do you know that small value premium persists, that the premium in previous decades was not just cyclical? Also, what are your thoughts of the allocation of value versus growth up one should have presently? So, these are really long-term proven factors of returns. And when I say long-term, it means, decades and hundreds of years of data. But one of the things that French and Farmer and people proponents of the factor-based investing have always said is that it's very difficult to know when these factors are prevalent. It's like that chart I showed you, of the few days, how many days that you miss when you invest. You miss some of these days and you lose out completely. And value can often come back in a very short burst. But really long-term value and small factors have proven to be persistent, pervasive, harvestable at low cost. And that's why dimensional funds are low cost. But what's different from just this idea of allocating between value and growth versus how dimensional does their investments, for example, is that dimensional is actually a passive investor. So when we talk about passive investing, it has to be across broad markets. And Dimensional does that. So their funds, their World Equity Fund, for example, has 12,000 stocks in it. 12,000 stocks is many, many more than the global, average global indexes. And they have all of that global exposure. But what they do is they tilt it towards the value versus the growth, towards the small versus the large, towards the quality versus the low quality. And therefore, so you're actually having broad market exposure with a tilt. So you're having the best of both worlds, and at a cost that is unmatchable in today's markets at 20, 30, 40 basis points. So I think that, this kind of, value versus growth is not great if you just buy value and you have no other exposure. Then it's a satellite position. It's not a core investment position. But dimensional, where we make the core advice portfolios through dimensional passive portfolios, which give you broad market exposure and tilts it towards the factors of returns that have shown to be persistent and may be coming back. We don't know. But the periods within which this premium is harvested can be cyclical, but the proven factors suggest that they are persistent over long periods of time. Are the core, Jared added a question, are the core portfolio allocations solely based on market cap with the small value? Does the funds target different areas, may change their weights over time? Yeah, so I think the core portfolios have an allocation tilt to small and value and quality, so higher earnings and higher quality, and small pockets of momentum as well, I believe. So, these are actively managed by Dimensional to optimize the portfolio to harvest these premiums at the lowest cost. So yeah, the weights do change over time, but my point again is that it is a broad market exposure. So they have 12,000, 10,000 stocks versus 6,000 stocks in the global index. And so they would own the broad market. Rather than concentrate that bet and only buy value or only buy small. That's not what they do. They buy the broad market, but they tilt it to those funds. What are the thoughts of the allocation move? In terms of P ratio, Jack Bogle has famously said the inflated P ratio is unsustainable and has been wrong for many years. Is this a bubble? Well, Jack Bogle, I'm not exactly familiar with the quote that he has made. Inflated P ratios are unsustainable if it keeps rising and it breaks at a certain point. But as a practitioner, someone who's invested money in client assets for decades, I can tell you for a fact that valuation is rarely ever a catalyst for a bubble bursting. It's normally demand and supply factors that shift. And there's something that happens that triggers that, and it's something that is different every time. Cycles rhyme, but they're not exactly the same. So different things and different asset classes drive bubbles and burst at different times. But there is no magic number. Like 25 times PE is not the peak. 35 times is not the peak. 45 times is not the peak. If you had seen if I go back to one of the very first charts about the CAPE ratio, and you look at what the historical CAPE ratio would have told you in 1999, you would have thought that 1929 historically 33.5 times is the highest it's ever gone. At 33.5 times, we should have sold the market and you would have been killed because you would have shorted the market and you would have had to cover at 45 times. We don't know. We don't know whether this is going to go to 45 this time or whether it goes to 55 this time or whether this is it and tomorrow it starts falling back down to 25. We don't know. And that's the problem, is that human beings are notoriously bad at predicting the future. And so we will need to see, but we will see. There are telltale signs that I've shown today that maybe there are cracks appearing in certain spaces like technology. But then again, if you look at the earnings of the technology companies, their earnings are coming out great. So maybe it's just a correction, a pause that refreshes, and then we climb the wall of worry again, and the markets do what they do, which is upward movement that is higher. So we'll see. The next question is, we have a couple of questions on ESGs, and then guys, I think I'm going to have to end it since it's 8 o'clock and I haven't eaten, and I don't want to keep people also for too long. There's a question among on ESG asking, is ESG growing to be another bubble in the next 5 to 10 years? And then another question slightly below, do you think specific ESG thematic plays like clean energy are bubbles? Will it affect the overall ESG investments? Yeah, I mean, ESG is a fad. It's a very, very in vogue name right now, and people are talking about it a lot. But how long has it been? It's really just been maybe a couple of years where it's really come into the common vernacular. I think many people still don't even know what ESG is. Maybe it's like crypto 5 years ago. So yeah, maybe there is, publish features, and I think people talk about ESG and talk about it in the same breath as technology or innovation or thematic investing. I don't think it's the same thing. I don't think clean energy is the only thing in ESG. I think ESG is about really making companies much more responsible about their governance, their social, and their environmental duties. And if companies do that well, those companies will be long-term winners, and therefore we'll be able to choose those winners. And sometimes that's not necessarily the best ESG companies, the best in class ESG companies. They may be a core allocation, but it may be the companies that are slightly below that, but have the potential to improve their ESG scores. And as they do, we generate alpha in the performance of these ESG stocks. So this concept of active engagement with companies, whether you're an equities investor or a bond investor, these fund managers, who are the leading proponents and executioners of ESG investing, can engage companies and turn them around, vote through proxy, go join their board, or, meet with management and convince them to do better on their E, S, and G scores. And as a result, the companies improve, and their financial performance also improves, and therefore their equities and bond performance actually improves as well. And that's maybe a way to improve returns as well. So ESG is a much more sophisticated way of investing. It's not something that replaces traditional investing. It actually supplements and enhances and improves traditional investment methodologies. It actually, I think, is a much, much higher quality investing, and a much more robust due diligence of the underlying securities and companies that you're investing in. And therefore, I think that it will be the norm, that ESG will not be a niche or a category. It will be the norm in the future, that every investment will be an ESG investment. And only companies that have a high standard of ESG will survive the scrutiny of consumers who are their clients, but also investors who are investing as well. So with that, thank you so much for all the questions. Guys, I would love to answer more, but I think we've run out of time. Sorry, maybe I can't resist myself. I'll answer these couple more recent questions that came in. What is causing the huge outflow of tech stocks? Do you think tech stocks will rebound? Who knows? Sorry, I can't predict the future either. But having said that, I would say that it's been a healthy correction already. These outflows are people who are panicking and selling. So we've seen negative flows, which is always a good sign, because it normally is a sign of capitulation. And I think maybe we'll, divide the wheat from the chaff. The good tech companies versus the poor tech companies, and that's what 2000 tech bubble really did. Is that actually you were able to buy Amazon on the cheap because the whole sector got sold down. The baby was thrown out with the bathwater. And what it ended up being was that a lot of the crappy companies went to zero. And the good companies, we had an amazing buying opportunity that didn't return. And so, we will see that again. There's a lot of software technology companies that will be winners of the future who are now being sold down together, with the whole tech industry sell down. So I think, doing the work yourself to find these good companies, or, finding a great investor like a fund manager with technology funds and innovation funds that, are aligned to your investment philosophy would be great. And so Endowus is also going to be Endowus will be working with fund management companies to introduce more broader choice in your investment options, and technology innovation funds are one of them. I guess we were a little bit hesitant to jump on the bandwagon and push these funds before, because we were hesitant. But I think with a healthy correction, I think we can onboard some technology and innovation funds, and we'd love to get your feedback on what other funds that you would love to see on the FundSmart platform. And just a final quick plug to let you know that Endowus is really the cheapest platform through which you can buy unit trusts here in Singapore. One thing that you need to understand is that banks are charging you 3% sales charges or 1% sales charge, and mutual funds with trailer fees, which are leading to bad outcomes. And it's no different for fund platforms like Fund Supermart and Dolodex. And Endowus is, for many funds, the cheapest way to buy a single fund. And we'll be onboarding a lot more funds in the coming weeks and months. So please look out for that. And also, check out the funds that are in FundSmart. We'll continue to improve our user experience and continue to improve the data and the information that we provide. As you know, we're very strong on transparency and disclosure, and so we would love to do that continuously. So thank you guys for joining me today for this long, over an hour session. Sorry about the hiccup. And yeah, I feel sorry, don't feel bad about that. I had a late lunch, and so I'm just wrapping up and go eat a bite. I know it's lockdown and semi-lockdown, and things are difficult. So we're rooting you on. Hang in there. Enjoy the time with your family and loved ones if you can. Try to exercise, be healthy, stay healthy and safe. Most of all, let's follow the protocols and safety so that we can all get out of this faster. We're doing our part by moving completely 100% work from home. We have had some exposure to COVID with a couple of our employees being exposed, but we luckily have no exposure internally because we moved to work from home very quickly, even as the government announcements came out. So we didn't have any cross infections as a firm. So we're doing our part, and hopefully we can get over this quickly. But in the meantime, we will continue to introduce you with great content. And also, next week's webinar on cryptocurrency is going to be fun. So, if I didn't answer a couple of your questions on crypto, then please join us next week. It's going to be a really, really fun discussion with KK. So looking forward to that. And many of you don't know, but I'm quite an expert in crypto. So look forward to my views as well. Please join us next week. And thank you so much for being with us today. Have a wonderful evening and wonderful rest of the week, and see you next week.